Welcome to the Daily Update, where I'll go over the action in the market for Monday, March 4th, and then we'll see how things look for Tuesday, March 5th. Before I get started, I want to welcome new subscribers. I've been picking up quite a number over the last couple of weeks, and I want to just say my heartfelt thank you for subscribing to the channel. I hope you find some value in the videos that I post, and welcome. As far as what happened on Monday, it was kind of a sleepy day. We were a little bit negative, yet we're still remaining positive when we look at our charts. We have some big economic reports coming out in Tuesday's session and then in Friday's session, and the market is a little apprehensive ahead of that. Of course, over the weekend, a lot of the news was, oh, this is a blow off top. Oh, we're going to have the 50% crash. And that may all happen, but we're seeing an awful lot of negativity as the market keeps going up, that it can't go higher, it can't go higher, and then it goes higher. Just like when we're really going down, it can't go lower, it can't go lower, and then it goes lower. So it's interesting how that works. But for right now, our stance is positive. Of course, we have a lot of things that we should keep an eye on that are causing us some concern. But when we take all of our charts together, we're still looking okay, but wondering if things are going to shift as the week plays out. Let's go back and talk about what happened. We did have a lower open, and then prices just slowly climbed back to the unchanged level. We didn't see an awful lot of gyration. It was pretty quiet. We just gradually moved higher, and then prices rose later in the day. It looked like we were trying to break out, but we hit that 5150 level. So we set another new intraday high, not a closing high. And then we dropped back down below the unchanged level to close negative on the day. We were down 0.12%, so not a really big move, but volume was above average. So even though it was kind of a sleepy day, we saw a lot of activity. The technicals are still positive right now. We are looking overextended to the upside. We do see some potential negative seasonality coming into the picture at some point, and it's going to be about inflation and interest rates. And can the market still continue on with this current scenario that it looks like the Fed is done raising rates and that they're going to cut rates at some point in 2024? We don't know when. We don't really know how much. Market just seems to be more in a Goldilocks environment right now as far as the economy is concerned, but that will change. It's going to either get too strong or too soft. And of course, there's a lot of geopolitical events happening inside the US and outside of the US that the market just really isn't paying all that much attention to. Some comments. Both the S&P and the NASDAQ did hit new intraday highs, but they ended up closing lower on the session. The mega caps ended up underperforming, and I have one of the Magnificent Seven charts. I'm going to show you Google later on. It's dealing with its 200-day moving average right now, and that could be negative, and I'll talk more about that when I get to that chart. But the broad market actually held up better. There was some Fed speak. Atlanta Fed President Bostic, who's a voter, said that inflation has decelerated over the past year. We kind of already know that, but that price pressures they're still widespread. We kind of know that as well, but we're hearing it from an official, and so that makes it a little bit more important. Here's our short-term list of things looking extreme positive, or you could say overbought. We have the Stochc RSI, the Williams percent R, the CCI 14 and 20, the stochastics chart, the standard deviations chart, the boom indicator saying we're kind of far away from the 20-period moving average, and the RSI 9. This really hasn't changed all that much, so we haven't done much to work off this extreme positive condition. We have a new addition to the list on the intermediate term list. The CMB composite is now looking extreme. We're still keeping an eye on our oscillators. They're starting, at least the shorter to intermediate term ones are trying to go back above their moving average, but they're already extreme positive. And then the boom indicator based on 50 periods, the bullish percent index for the S&P, it climbed a little bit. That was one positive thing that happened. And then our new high, new low study based on 10 periods for the S&P. We still have our longer term moving averages, the 150 and 200, that remain extreme positive. I've already gone through the current scenario of what we're kind of working with as far as the Fed is concerned. The dollar was up slightly, and interest rates, should be up. We actually went up to 4.22% in Monday's session. and the yield curves that we follow are still inverted. Sentiment is still extreme. Even with the slight down day, we went up. This is strange. In Friday session, we were up and sentiment ticked down. In Monday session, we were down and sentiment ticked up. They usually go hand in hand with each other. We're coming in at 79 now. That's a pretty high reading, where we had been at 77, and we're above that 75 level. And as I always say, this is the point where we can ride this for a while, but this is also the point when we start to think, okay, maybe some kind of a decline or pullback is in order at some point to wear off this extreme optimism. Our trend, it's trying to go above the moving average. So I've changed this over to an ADX that is strengthening, because both in the short and intermediate term, they're trying to go above the moving average. It's positive. The green line's on top, but be aware the green line is above 40. Because of the slight down day, I'm keeping our bias at mixed, and we're kind of not really sure where things are going to go in Tuesday's session based on the ISM report coming out, but I'm still keeping our momentum at positive for right now. We didn't have any economic reports in Monday's session. So here's some Isabel net charts, and I know this is blurry. I try to blow this up and make this look a little better. This is put out by Carson. They have some useful charts that we run across from time to time. It says the run since the October lows could still have room to go. What they're measuring here is what happens after we've had a 20%, greater than a 20% gain in 18 weeks. And then down below, these are the statistics looking out, where if you go 1 month out, it's not all that great. It's a little over 50%, but you go 3, 6, and 12 months out, and the success rate is pretty high, and the return is pretty good as well. This is another chart that I got from IsabelNet, and I'm not a big pattern person. I know some of you that watch these videos are. I'm not into the bearish wedges and the triangles and all that. And if you are, great, stick with it. I just found that they fail as much as they help over the years. I like to use flat lines as much as possible, and then trend lines when I have to. This is considered to be a cup and handle, and this is a positive look. If we keep going up with this same type of chart look, they're looking at about 5,600 for the S&P 500 right now. Of course, if we turn and start to go down, all the charts are going to switch and show how low we could possibly go. It just tends to work out that way. Then looking forward, it is showing that the small caps and mid caps, they still remain below historical averages on a valuation basis. Of course, one thing to just think about, I mean, I understand the idea behind getting in small caps. They're small companies. It's more of a ground floor opportunity. And even companies like NVIDIA, Microsoft, Amazon, they started as small cap company. Not so much Google. They were so big by the time they started trading their stock that they just flew right in as a large cap. But there's a lot of companies out there that are noise, that are doing things that don't really lead to anything. For every one Microsoft, there's 1,000 other companies that end up not doing all that well. And that's one of the reasons why we might be seeing a lower valuation. Also, small caps have to borrow a lot of money. And so when interest rates are going up, that puts more pressure on them. But looking at them on a valuation basis, we have the S&P, which is right around 20 times earnings, and that's what I went over the weekend. And then the mid caps are right around 15, and the small caps are at about 14. We use that static scale, 10, 15, and 20, with the small and mid caps being right around that 15 range. And then I kind of binge a little bit from time to time when it comes to Twitter or X or whatever they're calling it these days. Sometimes I spend a lot of time on there. Other times I go days, maybe even weeks, and don't really even look. But I started following barchart.com, which is a site that I've been going to for a long time. But they seem to have some pretty interesting posts that they put on Twitter. If you use Twitter, you might consider following them. And the charts that you see after this pretty much came from them. One of the things that they posted that came out of, I think this was from Bloomberg ultimately, I guess it's S&P Global Data. It says, when we go up and then we start to come down, what are the recovery times when the market really starts to drop? And if it's from 5% to just under 10%, Okay. It takes about 1.5 months for us to get that back. The longer, I should say, the deeper the correction, the longer it takes us to return. But eventually we do return. And that's why I try to be a realist when it comes to the markets. There's a time when it goes up, there's a time when it goes down. But to always be a bull, to always be a bear, if you look at a long-term chart and some kind of loose studies that I looked at this, about 70% of the time over the course of the last 100 plus years, the market goes up. And then about 30% of the time it goes down. So that would mean that about 70% of the time we need to be positive on the market because that's what it tends to do. But then the 30%, that tends to do a lot of damage, and that tends to happen a lot quicker. But we need to be just realistic with this. Go with it when we're going up. Look at our charts. Let our charts tell us what's actually happening. And then when our charts start to tell us that things are turning negative, then we switch over to more of a negative stance. Okay, there, that's all for that. Also, this is kind of negative, but not necessarily extreme negative. They also posted a chart from Bloomberg this time that there's an uptick in insider sales. Insider, these are the people inside the companies. These are the CEOs and the officers, the people that really know what's going on. And if you look over on the right-hand side, here's the Magnificent Seven, and they are seeing an increase in selling. Now, if you had a stock that was at 200 and now is at 800, and you're thinking, okay, it might go to $1 billion, but right now I could buy that house if I sell this stock. Yeah, it might be a pretty good thing to do. So, and this data can often be delayed as well, since it takes the time for these reports to actually be updated. But just be aware of that. There is an increase in insider selling when it comes to the Magnificent Seven. This is also showing insider trading activity, follow the smart money. What they're really bringing out here is that they're seeing a lot more selling than buying as these reports are released. Just something to be aware of. This goes back over the last 60 days or roughly 2 months. And then this is the rolling 4-month change in the S&P. The current rally is typical of a post-recession rally. Well, I don't know if you could consider COVID really a recession. We did go negative there with GDP for a while. And then with all the liquidity that was added to the market, we really shot up. Or it could also be a bubble. And we don't really know that right now. Yeah, there are signs that we're dealing with a bubble right now. You've got Bitcoin hitting all-time highs. You've got gold breaking out. You've got the Magnificent Seven that are just going to the moon. You've got people downloading apps to their phones who don't really know what they're doing, buying things. And that's usually what happens when we start to get to some kind of a top. We saw it way back in the dot-com bubble. And then in 2006, 2007, we saw it in real estate. When people who knew nothing about real estate were suddenly buying and selling houses, that's when you can pretty much suggest that we're at a top. We're kind of seeing that activity, but this could still go on for a while as well, or it could lead to some kind of a decline to eventually really do some damage. But that's what they're just trying to figure out here. We're starting to get a pretty high upsurge in the S&P 500 that may mean that we're out of the recession, or it could mean that we're going into a bubble. Then here's the valuation of high growth stocks. It's lower than it has been. It's at 89%, where the average is at 57%. This is just suggesting that the high growth stocks are overvalued right now. And then I'm not going to read this out. I actually posted this on the community tab on the YouTube channel. We are keeping an eye on the banks. And when I say that, here's a good list to start with. And I posted it there because there's a lot of stuff you could go through and read. I'm just focusing on this left-hand column, looking at the names of these banks. I actually have a very dear friend who just retired from Columbia Bank. But we'll just kind of keep an eye on them and see. These are smaller banks that if real estate loans really start to come into a real problem, these are the banks that might get hit with that. And this could lead to more of a banking problem. All right, let's go back and look at our intraday analysis where we did open lower. Not much of a gap, a little bit of a gap here, but then we just clawed our way back to the unchanged level. We tried to shoot up, but that didn't last very long. We went sideways and then came back down and ended up closing lower. Our intraday chart, I guess a little bit of a gap from Friday's close to when the futures started trading Sunday afternoon, but then we drifted lower, and then that led to the lower open in the cash session, and we're drifting off just a little bit in the initial overnight session. We're seeing growth underperforming value just a little bit on an intraday basis. That's a slight concern. This is also a slight concern too, where the growth to value ratio intraday did show where growth underperformed. Our end of day charts growth was down where value was up for the large caps. It was up for the mid caps, and the mid caps had a pretty good day. And the small caps even started off fairly well, but they didn't end all that well. They were down with growth compared to value, but they were down about half as much. So we are still seeing an improvement here with our small cap growth to value ratio. It isn't breaking out above this previous high, but it did go up on Monday, where we actually declined a little bit with the mid caps, but overall we've been seeing more of an uptrend. We went up just barely with our S&P growth to value ratio. So far this is holding up for right now, and we want to keep an eye on that. We went up to sideways with our discretionary to staples ratio. Again, we want to see this going up if we're going to stay more positive. If this really starts to turn down, that will be a warning sign. Our trend, we're trying to get above the moving average. So you could suggest that we're in a strengthening trend. The green line is on top, but it is above 40. However, it can stay above 40 for quite a while, and the red line is really declining. So this is a strengthening, positive, trending environment right now. And here's our short-term chart, also showing that we're going above the moving average. The green line's extreme, the red line is coming down. We did tick up to above average with volume. And then sentiment, this is the chart that we look at once a week. We came down a little bit. We're right on the border between greed and extreme greed, which is kind of lining up with what we're seeing when we look at all of our charts together. Our Ulcer Index actually ticked down just a little bit and is just not showing an awful lot of fear. We ticked up a little bit with the VIX on the line chart as well as the bar chart, and the volatility of the VIX also kicked up a little bit with the bar chart as well as the line chart with the slight down day. We are seeing the momentum of the MACD continue to fall after the momentum had been going up since the beginning of December. We'll see if that can continue. And our equity put call ratio based on 1 day, we ticked up, but with our 5 period, we're still continuing to decline. So that's positive. And we're inching up a little bit more into this big red area now with the skew index. This is suggesting, now it could go higher than where we're at right now, but suggesting that the market is expecting some kind of a big move. We're not sure if that's going to be an up move or a down move right now, but they are expecting something. Our advanced decline line, we actually broke out and set some new highs with the advanced decline line based on price, and we're also improving based on volume. The new highs, we just skyrocketed up with the new highs, and our 5 period is still looking okay, even though it's rolling over a little bit. And our 10 period continues to advance. We're positive when we look at the advanced decline ratio. Accumulation distribution did decline, but is still above the moving average. The Chaikin money flow turned down just a little bit, but is still positive. The Chaikin oscillator also declined, but is positive. We came down just a little bit with the common stock on the NYSE when looking at our advanced decline lines. We were up with the S&P, up with the mid caps, and down with the small caps. In our daily chart, we're still above this upward sloping trend line. We have not broken below that yet. On the bottom, we were above average with volume. And then we have our usual suspects, the Stochk RSI being extreme positive, the Williams percent R, the CCI 14, and the CCI 20. We're still looking extreme when we measure how far away are we from the 20 period moving average and the 50 period moving average. We're continuing to go up. Now, this is a moving average just on the S&P itself. It's not looking inside of the S&P. Our different moving average studies continue to go up. And we actually declined a little bit, but we're still positive with the force index. We're still extreme positive in the short, intermediate, and long term with the stochastics. And we're still in the +3 channel with our standard deviations chart. Balance of power is above the midpoint and going up. That's positive. Here's another new reading. Now, I put this black line on here. I just took a bigger look at this indicator and I thought, okay, where are the extreme points? And I just decided to put the black line right there. So there's nothing magical about that. It's more just what I observed myself, but we are starting to get extreme here. We're still positive with the go, no-go system. We're positive with the highest high value. The TTM squeeze is positive. The ease of movement, it flattened out a little bit, but we're still above zero. The Arun ended up going up just a little bit, and we're not extreme, so that is positive. We did see a little bit of an improvement with the McClellan oscillator with the S&P, but we're still watching this longer-term negative divergence. We're going up with the summation index based on price and volume. That's positive, but we still have this longer-term negative divergence that's causing concern. The NYSE McClellan oscillator went down, but is still above zero, also watching this longer-term negative divergence. So it looks like we're still going up here with this since we're still above zero. So we're going up based on price and volume with the summation index for the NYSE. This was negative after Friday and then was positive after Monday. The Swenlin trading oscillator based on price and volume advanced, and both are above zero. And we're trying to get above the moving average with the PMO. We're above the moving average based on price. We're trying to get further above the moving average based on volume. We were pretty much flat to slightly declining with the PMOs that are rising. The buy signals are still going up, and the PMOs above zero are still going up as well. We're still positive with the Elder's Impulse system for the S&P, but this is a little scary looking bar to open and then close at the low end of the bar. We're still positive, though, with the parabolic SAR. We're trying to turn up with the slope oscillator, and the MACD is trying to go above its moving average. And we're seeing that in the short and intermediate term, where in the long term, we're just kind of right on top of the moving average to even slightly negative. We're still above all of the plotted moving averages here. If we break below that trend line, this will be the next level that we're watching. It's right at about 5,032 currently. This was also encouraging. The bullish percent index, even on a down day, it did go back above. Now, it's giving us an extreme reading, but it did go up on a down day, and that is encouraging. We did go up with the NYSE bullish percent index, but we declined slightly with the NASDAQ 100 bullish percent index. The money flow is still above 50 and advancing. That's positive. We're starting to decline with the ultimate oscillator, but we're still above 50. The vortex did turn back up with the green line on top. We're no longer extreme with the 14-period RSI. We're coming down a little bit, but most of the readings lately have been above 50. We're still just barely extreme positive with the RSI based on 9 periods. On-balance volume did decline, but it's still positive. And we're seeing some improvement here with the 20-period moving averages. Now, these are the stocks inside of the S&P. And we are seeing this negative divergence, but they have been making a comeback lately as the S&P has been going up. So this is looking a little better. We're also seeing a slight improvement when we look at those stocks above their 200-day moving average in the S&P and the 50-period moving averages. But as I've been trying to point out, we still have these longer-term negative divergences that are causing some concern. Now, if we can come back to these high levels again, it'll negate that negative divergence. The Copic curve continues to be negative, even though it's trying to cross above its moving average. The Sean trend meter is now looking quite extreme positive. And when we look at the trend, the Heiken Ashi is still positive, the Kegi is positive, the Renko is positive, and the 3-line break is positive. Our trend line, we're still above this. We haven't broken down below it yet. We're just keeping an eye on that for right now. And we're still a little bit above this long-term resistance, which now possibly could be support. That's at about the 51.11 area. And so we closed at 51.30. So we're above that a little bit now. That's going to be an area that we're going to continue to watch. But we're still extreme positive with our 150 and 200 period moving averages. We're still positive on all the different indexes and time frames according to the Keller model. We had a lot more blue than red in Monday's session. The S&P did set a new all-time high, but that was an intraday high. And then gold, that saw a bit of a breakout. And you got the gold people just partying like it's New Year's Eve now. They're just sure the next stop is the moon this time. No, really, this time. All right. And then the equal weight is still hanging in there pretty well. We're seeing a little bit better performance from the broader market right now, even though we declined slightly with our ratio here. The Dow is pretty much chopping sideways, but still hanging on to previous gains. The diamonds have switched from being positive to neutral, and we were down just a little bit with the NASDAQ after setting an all-time high, but still looking positive. The NASDAQ 100 also declined 0.42% after hitting this R1 level. So we'll be keeping an eye on that. But we still continue to be positive with the QQQs, with the Elders Impulse system. The momentum for the NASDAQ 100 is now crossing above its moving average. So that's turning back positive. This is the longer term chart. We're still above this long-term ratio here. We're going to see, can we stay above that? And possibly even, now it went down in Monday's session, but can it come back and actually take out these previous highs that a lot of folks are really concerned about? The small caps, they were down after having a really good week last week, but they still remain positive with the Elders Impulse system. The Russell 2000, that's what more folks tend to focus on right now. We did show a nice little breakout. We had a good solid open with the small caps, but we ended up giving that back. We are above, at least on an intraday basis, these previous highs here. The RSI is still above 50. We're still in a longer term uptrend, and the shorter term momentum is still positive. The mid caps also opened up, looked really good, but then spent the rest of the day giving a lot of that back. But they continue to be positive with the Elders Impulse system. This is Google, and I don't focus so much on the Magnificent Seven by showing the charts because I don't want it to be about NVIDIA, Google, Apple, Amazon. We're just looking at this, and the reason why I'm bringing this up, I look at the charts every day, but I don't always talk about them. We're coming down to the 200-day moving average with Google. Now, are we going to be able to bounce up off of that? If we really drop below that, that could turn things more negative. The FANG index was also down 1%, but still very close to all-time highs. The financial sector was up, even though we had more bad news from New York Community Bank. This bank just can't get a break. They were down another 23% to $2.73 a share. And the dollar was up slightly, and we are above both of the moving averages. So dollar strength could put some pressure on stocks. We were up with the 10-year yield. We were down with the 10-year based on price. And then this showed up again. It didn't show up before. Isn't this such an important chart here? When we look at the growth to value ratios, the Qs to S&P are above the moving average. We saw a discretionary fall back under the moving average compared to the S&P. We turned down, but we're still above the moving average when we look at large cap growth versus large cap value. So looking at all the different indexes, growth is still positive, mid caps still above the moving average, and small caps are showing some improvement there. And then we're still positive with our broad market look at the 5-period moving average of the highs minus the lows. We're still extreme positive with the 10-period average of the S&P 500 highs minus the lows. And we're continuing to decline with our staples to S&P 500 ratio. And this tends to be supportive for the market. So what's our outlook for Tuesday? Twice a year, the chairperson of the Fed has to come and testify before Congress. They'll do it this coming week. They're going to do it again this summer. And it's nothing to freak out. It's not like he's being hauled in front of Congress to answer for things. This is something that he's supposed to do. And that'll be on Wednesday and Thursday. The first day, he'll have some prepared remarks. It's going to be the Q&A that the market's really going to focus in on. They're going to look for how he answers things, the tone of his voice, what he ate for breakfast, you know, all this weird stuff. But they're not really expecting any surprises. So what does that mean? We need to at least be on guard for something shocking to happen. Hopefully that will not be anything, but when the market is really assuming something is not going to happen, sometimes that can be when it does happen. So they expect him to just talk about that, yeah, the Fed's probably going to cut rates, but we're not in a real big hurry to do that. The technicals are still positive. We're still looking at an overbought or extreme positive condition. We're still above that overhead resistance, and we're still potentially coming into some historical weak seasonality. We're going to get the S&P Global U.S. Services PMI, the final reading, and factory orders. The big one is going to be the ISM non-manufacturing. That's kind of what the market was waiting in limbo for in Monday's session to see what happens in Tuesday's session. And then we want to watch the geopolitical events. Here's the economic calendar where I just list the different things that are happening. The next big one is going to be the employment situation report on Friday. Now, I wanted to include a little bit different look at the economic calendar. And if you have an opinion about this, you can say, "Oh, it's great. It sucks." If you don't have an opinion, don't say anything. But this actually is including when they have it, what the forecast is going to be, what the last reading was. So on one page or one slide, you can kind of see where we're at with things. I tend to usually just mention what's happening. I don't go into what the last was and the forecast is, and until the report actually comes out. So see if you find this a little more helpful. Seasonality. We're neutral to positive across the board when we look at March 5th for the Dow, S&P, and NASDAQ. And we're looking okay for Tuesday's session on a historical seasonal basis. It's after this. This is when we start to see some weak seasonality, at least going for the next few trading days before we might see a bit of a bounce. And then we're also in that window where this could be the bouncy time right now before we end up seeing a little bit more weakness. And then when the current president is running for re-election, we're following the black line, which historically we might see some weakness after we have a day or two of things going well. Doesn't mean it's going to play out that way. We're just looking at what has already happened in the past. Tuesday tends to be not the most negative day of the week, but it usually is down when you compare it to 2023. Tom Bowley has his research for the month of March, where it tends to be modestly bullish, where the first few days are positive, then we go through a weak time, then in the middle part, we see some strength, then we go through a weak time, and then we tend to finish off pretty strong. Warning signs. Growth may be showing signs of weakness. I put that on there just to kind of be aware. It's still looking okay for right now, and it's holding up. But if we have another down session, we're really going to be watching those growth to value ratios. Volume has usually been decreasing as the S&P goes up. We're still kind of seeing that. Monday was a down day, and we did see an increase in volume. We're going to see if we see a shift in that. And there's also a lot of negative divergences. Even though our S&P oscillators are turning more positive, they're still negatively diverging from highs that they set back in December. The McClellan oscillators and summation indexes, they're still negatively diverging. The small caps and mid caps, they've got a long ways to go to set all-time highs. The discretionary sector from the S&P, even though it is showing some improvement, the transports are just not looking very good right now. And the Copic curve is negative, but it's trying to cross its moving average. And we're potentially entering a period of historical weakness. Positive signs. We're still going down with the equity put call ratio based on 5 periods. The parabolic SAR is positive. Our oscillators, even though we see some negative divergences, and even though they're going back above their moving averages, they are extreme positive, but they are positive for right now. The vortex is positive. The momentum for the NASDAQ 100 is turning more positive. Small and mid-cap growth is still hanging in there for right now. The financial sector is still positive. So our conclusion, we're positive. We're still in the process of potentially suggesting that we're overbought. We're still above overhead resistance, and we're wondering if weak seasonality is going to come into the picture. That's what we're watching in the short term. Intermediate term, we're seeing if things start to show some weakness there, but we're not seeing an awful lot of that. We're seeing some extreme positive readings, but we're not seeing an awful lot of weakness right yet anyway. Long term, we're still overbought because we're above the 150 and 200 period moving averages. Thank you. I really hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.